Good morning, everybody. It's Tuesday morning, 10 a.m. Time for our weekly webinar. Good to see everybody. Hope you had a great weekend. Hope you're having a great week so far. So let's dive right into it. Remember that you are being recorded. You are muted, but you can use your Q&A button at the bottom of the screen and ask me questions as we go. With these recordings I send out, I hope you're receiving those. So I sent one out for you over the weekend, and we talked about the investment fundamentals. Last week was about risk management. This week in our investment fundamentals section during financial planning, we're going to talk about bonds. So there's a lot of talk about interest rates and bonds. So I thought it was a good time to talk about that in our series. We'll continue with this investment fundamental series for a couple more weeks. And then we're going to shift over to a financial planning series. So that should be really fun and exciting. So we're ending our Changing World of Retirement Planning class this evening. If you're one of the folks joining us for the class tonight, that'll be the third of the 3-class series. We'll start promptly at 6:30. So make sure you join us for that. This will be the last class for the year. I had hoped to have another one in December, but just with scheduling, and I have to be out of the office a couple of weeks at different conferences, one in October, and it looks like one in November. So we want to make sure, or I couldn't fit it in. So if you're joining us on YouTube, please subscribe, like, and hit the notification button. I'll remind you that again when we cut over to the financial planning portion. But a lot of folks are running us on YouTube now, so I want to make sure that that we're updating those subscribers. So I appreciate that. So I talked about you're being muted. Chat is disabled. Actually, that may not be the case anymore. And you can use your Q&A. So I think everyone should be here with us now. So click that raise hand button for me and let me know if you can see me and hear me okay. I appreciate that. Thank you. So like we always do, we'll go through a series of a few things. I like to start with sometimes some headlines that really don't have anything that jumped out at me this morning. So we'll start with our slot updates, and then we'll talk a bit about the markets, and I have some analyst reports I'll review with you, and then we'll get into our financial planning topic, and we should wrap up about 10:45 or so. So we do have a special guest webinar coming up in October 26th. Heather Schreiber, who's a Social Security expert, is going to be joining us. So that should be a lot of fun and really, really informative. I've told you about our new website that's coming. So we began doing work. It's a tremendous amount of work. You know, this group is building this website in the background, but they just keep asking for information, and it's a tremendous amount of work. So I'm excited about that. I've seen some of the work that they've done, and I think you're going to really find it helpful. All right, let's get into it. So here we are. My headline that I'm still carrying is the Consumer Price Index. You know, that's we're going to talk about that during our investment section. So I'm going to share my screen here, and we're going to go over the slot updates. All right, you should see my screen, and these are my notes. So just raise your hand if you can see where it says Roth conversions and inherited IRA RMDs. Thank you, everyone. So this is from Ian Berger. So I thought these were two really good questions. And it shows the complex nature of inherited IRAs, and then also just handling your own 401ks and IRAs. And this first one in particular demands some discussion. So let's just read this question together. Late in December 2021, a taxpayer under age 59 and a half takes a distribution of his traditional, not Roth 401k, and has 20% withheld for federal tax. So let me just stop there. So the person is under 59 and a half, which means that if they're still working and they're not eligible for any kind of distribution from that IRA, that's an early, or excuse me, 401k, that's an early distribution. So with that comes a 10% excise tax on that distribution as well. Now they say, they further go on to say early in January 2022, the full 100% of the distribution is deposited into a Roth IRA. Does this avoid the 10% penalty for early distribution? Is this reportable as a Roth conversion in 2022 or 2021? Now, I'm just going to take a little test. Do you think that this is so distribution is done in 2021? It's a full distribution. And then the Roth conversion is done in 2022. Does anyone think that raise your hand if you think that might apply for a 2021 Roth conversion? I'm just curious. Ian really doesn't address it, but so just raise your hand if you think that. Okay, nobody. And it is Ian. He likes to go by Ian. So you would be right if you think that. But Ian, I read this yesterday, but let me make sure that he doesn't address it. But I don't think he really addresses it. He answers the 10% early distribution penalty does not apply to Roth conversions. It's not clear whether the taxpayer converted 80% of the distribution or came up with the funds out of pocket to make up the 20% withheld and convert the whole thing. If the taxpayer only converted 80%, then he would owe the 10% penalty on the 20% withheld. The 401k plan would report the distribution on the 2021 Form 1099-R, and the taxpayer could be taxed / penalized on the distribution of 2021, even if the conversion is delayed until 2022. The IRA custodian would report the conversion on 2022 Form 5498. So once the tax year passes, you can't go back and do a Roth conversion. So I'm going to actually talk to Ian about this when I see him in a few weeks. But this is an unnecessary complex situation, isn't it? Because really what this person should have done or could have done is just rolled over their 401k into an IRA. If they do a direct rollover from the 401k to the IRA, then they can do the conversion whenever they'd like. They could have done it in December 2021, and there might be good reasons for that, or there might be good reasons for waiting until 2022. But in this case, they just really caused an issue. And if, like Ian correctly says, if for instance they paid the tax with part of that distribution, then that is an early distribution. Even if the Roth conversion is acceptable, which I question if it is, even if the Roth conversion is acceptable, then the portion that is sent to pay for tax is considered an early distribution. So yes, the IRS says even if you're sending the money to us, we still consider it an early distribution. And not only would he then, in this example, pay 20% of it, right? They'll pay 20% of federal tax over the whole conversion or distribution, whatever you want to call it. They would then owe an extra 10% tax on the amount that's used to pay tax. I hope that makes sense. I know it's a little complicated. All right. The next one is a really good question by a person who really researched their information. They said, hello, I've done a lot of research on this, and one's head can spin as you read the different articles, hoping you can clear up these two questions. So this is about an inherited IRA. The situation, our 98-year-old mother passed in May 2022. So let's break this down kind of like a word problem. You'd circle that. If I was doing my CFP exam right now, I'd have a notepad and I would first circle 98-year-old mother. And that means she's past the required beginning date. And that means that anybody inheriting her funds, her IRAs under the new rules, must take distributions along that period of time, or required minimum distributions, and they're not able to wait until the end of that 10-year period because she's over her required beginning date. So that's a key point. 98-year-old mother passed in May 2022. She had both a Roth IRA and a traditional IRA. I'd also circle those. Roth IRA, you actually don't have to take those periodic distributions. It has to be all depleted by the end of 10 years. But traditional IRA, because she's past the required beginning date, must take those required minimum distributions along the way. So really complex rules here, right? Because she's over age 72, past her required beginning date, then the traditional IRA only are required to take those RMDs. The Roth IRA not required to take those RMDs, but both must be depleted at the end of those 10 years. But what if she was 70 years old? Well, if she was 70 years old, whether it's a traditional IRA or a Roth IRA, there is no need for required minimum distributions, but both accounts have to be distributed 100% by the end of 10 years. So like I said, the IRA or the Congress just made these rules more complicated over the past year than they'd ever been. Okay, she had both a Roth IRA and a traditional IRA, and we, her children, were the primary beneficiaries of both IRAs. She passed before taking her 2022 traditional IRA RMD. The broker created inherited Roth and traditional IRAs for us, and during the process sent us each a check that totals mom 2022 RMD amount, so that her 2022 year of death RMD was satisfied. So I'd circle that too. So mom has to take her last year's RMD if it wasn't already satisfied. So that's mom's, not the children's. So that was taken care of. I'd circle that, check it off, and write a note. So the question that that they have is on our inherited traditional IRAs. We understand that based on, they're talking about the rules here of February 22. The February 22 IRS guidance, we need to take annual RMDs, like I had talked about, from those accounts over 10 years and have the inherited traditional IRAs emptied by the end of the 10th year. With mom's 2022 RMD already having been satisfied, is our first year RMD year 2022 or 2023? So really good question. So mom's RMD was paid for 2022. Now the kids inherit it. Does that mean that they have to also take a required minimum distribution in 2022, or can they wait till 2023? And you can't say, well, logically, they can wait until 2023, because logic doesn't apply here. We're talking about IRS rules. Our understanding is that there are no annual RMDs on the inherited Roth IRAs. They got that right, but that we must have emptied them by the end of the 10th year. Is our understanding correct? So he says, thanks for fielding everyone's questions, sharing your answers. It's a great service. His name is Greg. So Ian writes, hi, Greg, appreciate the compliment and sorry for your loss. These rules are complicated, but you have a good grasp on them. Since mom died after her RMD required beginning date, the inherited traditional IRAs must be emptied by 2031-32, and annual RMDs based on the beneficiary single life expectancy. And you have access to those tables on our website. Must be taken starting in 2023. The rules are different for the inherited Roth IRAs. Those accounts also must be emptied by 2032, but annual RMDs are not required during the 10-year period because, wait a second, I lost my place. But annual RMDs are not required during the 10-year period because Roth IRA owners are always considered to have died before the required beginning date. He did not answer the question though about do they have to take a 2022 or another RMD? And the answer is they do not. So they will have to take a 2023 distribution, required minimum distribution, on just the traditional IRA. Oh, I'm sorry, he did. He said starting in 2023. Excuse me, on just the traditional IRA, not the Roth IRA. All right, I'm going to, you know what, I'll read this. I'll include this one next week because this is a long piece and we're already at the 15-minute mark. So this is about how Roth 401ks distributions are taxed, and it talks about qualified. You know what, let's just go through it. So this is again from Ian, and I'll just read through it and I'll try not to give as much commentary, but more and more 401k plans now offer Roth contributions. That's a great thing. At the same time, Americans are changing jobs and receiving 401k distributions in record numbers. I'll let you catch up. I'm right here. So it's a good time to review the tax rules that apply to Roth 401k withdrawals. The same rules also apply to Roth 403bs and Roth 457b withdrawals. So good to know. 401ks are most common, but we do see a lot still 403bs, and 457s are government type of savings plan. Roth 401k contributions are made with already taxed compensation. So if you are eligible for a distribution, you can withdraw the contributions themselves without paying tax. That's the contributions. If you are still working, you can't withdraw Roth contributions before age 59 and a half, except for hardship. But earnings on Roth contributions can only come out tax-free. The distribution is considered qualified. To be qualified, a distribution must satisfy two requirements. I'm right here. First, you must be at least 59 and a half at the time of distribution, or the distribution must be on account of your disability or death. Second, you must have held the Roth 401k account for more than 5 years. This 5-year holding period starts on January 1st of the first year you made a Roth contribution to the plan that the distribution is coming from. So even if you make that contribution on 12/31 of that year, it's considered January 1st. So it makes the calculation a little easier. Periods during which you make Roth contributions to other 401k plans don't count unless you, now these are specific to 401ks, not IRAs. Remember, the rules are different. Periods during which you made Roth contributions to other 401ks don't count unless you rolled over those contributions to your current employer's plan. Any other non-Roth 401k contributions are also ignored. So really important, people get it in their head that they can push all these things together because they're all 401ks. They do it with R&Ds, they do it with contributions, and they get themselves in a bind. So don't let yourself head down that path. So he gives two examples. I guess I'm going to share both of them. Example one from 2012 to 2018, Denise worked for Alpha Company and made Roth contributions to the Alpha 401k. In 2018, so 6 years later, Denise left Alpha and began working for Beta Company. She made her first Roth 401k contribution to that plan on July 1st, 2018. In 2022, at age 60, Denise wants to withdraw from her Beta Roth 401k account. If she does that, the earnings on the account will be taxable since her distributions won't be qualified. Although she's over 59 and a half for a 5-year holding period, which began January 1st, 2018, won't apply until December 31st, 2022, or won't make it until December 31st, 2022. Denise won't get credit for her Alpha Roth 401k contributions unless she rolls over the funds to the Beta 401k. If your distribution is not qualified, a portion will be subject to tax under the pro rata rule. This gets really confusing. To determine how much is taxable, follow these steps. Let's go through it. Step one, divide the amount of your Roth 401k contributions by your total Roth 401k account balance, contributions plus earnings. Step two, multiply the step one percentage by your total distribution amount. And step three, subtract the step two amount from your total distribution amount. So does anybody still want to do this on their own? Folks, I got to tell you, there's always, people that want to do, they attend a class, or they'll write into me with questions, or call in with questions, and they'll say, you know what, I got it. I see what you're doing. I'm going to do this on my own. And then things like this happen. And it's not just for those folks under 59 and a half. It's not just for, people with inherited IRAs. There's all kinds of little nuances, and you can see how it can get so complicated. And like I said, the IRS and Congress doesn't help us. They're not making it any simpler. So here's example number two. Denise, from example one, goes forward with a partial Roth 401k withdrawal of $20,000 from the Beta plan. She has made $35,000 of Beta Roth 401k deferrals, and her total Roth 401k account balance, contributions plus earnings, is $50,000. The step one fraction is 70%, 35,000 divided by 50. And the step two amount is 14,000, 20,000 divided by 70. Goodness gracious. I know if you're following this, I give you so much credit, because this is something, that I have to calculate. We use spreadsheets for this. This means the step three amount, the taxable portion of the $20,000 withdrawal, is $6,000. Denise can take the remaining $14,000 tax-free. All right. So here's a really easy way to handle this one too. First of all, even if Denise's, in this example, if Denise's plan allows it, I would, and she was doing distributions, I would consider rolling that into a Roth IRA. And then there's a portion, her contributions and any conversions are always going to be able to come out tax-free. So that's where that whole pro rata rule comes out. And it may be a situation, if you're creative in these kinds of strategies, where waiting another year might create some. So some people will say, well, I need $50,000, and it's here we are, September. Let's just call it October, right? People will say, I need $50,000, and it'll have a negative impact like this, or there'll be some complicated strategy, and they'll talk about what they need that $50,000 for, and I'll ask, well, can we take 25,000 of that in 2022 and $25,000 of that January 1, 2023? Now that may not have solved Denise's problem, but it could help, because it could have gotten her another year. And in fact, in this example, it would get her past December 31st, 2022. And actually looking at this without going through the details, it's likely that it would eliminate the need for this pro rata calculation. And Denise might say, oh yeah, you know what? I actually don't, I'm doing my kitchen or something like that. And the contractor needs half of it right now, but he probably won't need half until after the first year anyway. Or I have these other funds I can draw from that will be easier for the other half, and then we can replenish it. I just didn't want to take everything out of my savings account or take that much out of my savings account. So I'm putting some color around this that may not be there, but that's a really, really common example. So let's not, you can see how it can get very, very complicated, and people can just say, I'm taking that distribution. The person that you're talking to on the phone doing these phone centers, they may not realize what's involved with that distribution. And then you have to figure out the tax implications when you do your taxes several months later. So people get caught in those traps all the time. So try not to go it alone. We're here to help you with that. All right, so let's move on. I don't think I'm sharing my screen anymore. Let me just double check. We're going to quickly talk about the markets. All right, so everybody knows the stock market's been down pretty aggressively over the past couple of weeks, certainly since the Fed raised rates again, and we had the disappointing inflation number, 8.3. We're expecting 8.1. So, and I'm not optimistic. I don't know, but I'm not optimistic about what the inflation report is going to be next month. I hope it notches down, but who the heck knows? It's still a very, very difficult, globally, it's a very difficult situation. So in no way do I want to be pessimistic, but these are times, and I was speaking to someone yesterday who showed me on her phone, here's the balance of my 401k, and I'm very worried about it. And I said, well, listen, these are the times when you should be paying attention. Please don't let anybody tell you not to look at your statements, or, because people say that. People in my business say that. Well, don't look at your statements. Just stay the course. You should be looking at your statements, and you should know how this feels. And if you can, in fact, with how this feels, stay the course, because you just don't want to end up in a place. What if we don't have a quick recovery like we've always experienced in the past? So the Great Recession from the top to the bottom was about 18 months, and the recovery took some time. The global pandemic was very, very quick. Mid-year we were hit hard, and then by the end of the year, and really almost immediately we took off. But this is likely to be a tough go for the next, you've heard me say it, year and a half, 3 to 5 years. So pay attention. Now's the time more than ever to pay attention. And most of you folks, most of the folks I work with, most of the folks that are on this webinar on a weekly basis are either just starting in retirement or are just about to go on in retirement. And this is a vital time for you, and it's almost a perfect storm. So you've got to be very, very careful. So the Dow Jones Industrial Average was down 4% last week. The S&P 500 was down 4.63%. The NASDAQ was down over 5%. The world index was less. The US was down over 5.72%. The emerging markets down 4%. All of them, even small caps, 6%. They're all down double digits for the year, right? So year to date, the NASDAQ is down 30, the S&P 500 is down 21, and now Dow Jones Industrial Average is down 17. Global markets are down anywhere from 24 to 25%. And as you hear me say all the time, we're going to talk about bonds today. The bond index, the most common bond index that people track, is down 13.75. So for most people, and this is why people are, looking at their phones and looking at their statements and say, wait a minute, I'm in the, this person was in the Fidelity. This is not a recommendation to not use or to use these funds, but they're in a Fidelity age-based fund or target date fund. And why is it down when it should be ratcheting up more towards bonds? Well, now stocks are down more than bonds, but they were hovering about equal for a long time, right? So bonds are still down 13.75% on the average. Some of them on the shorter 1 to 3 year bonds are down 4.5%, but still, that is what most people consider their safe money. Air quotes, if you're listening. So that can be challenging. So it'll continue to be a challenging time for some time. Just you want to stay with your plan, but you have to have a plan, and you have to review your statements. You have to review your plan, and you should do the review of the plan on an annual basis. You know this. But if you work with us, lean on us. If you have questions, if you work with somebody else, make sure you're checking to see what's going on and if you're in the right things. All right. I like Jason Zweig, as you know, from the Wall Street Journal. He talks about the effect of some of the higher quality companies, and that even they're seeing significant drops. He also talked about an exchange traded fund. I'm not going to name the exchange traded fund because I don't like to talk about individual securities on these webinars, especially when people pull them off of YouTube, because I don't want it to be seen as a recommendation either way. But he talked about how one fund that two different funds that hold similar securities, one was down 5% more than the other, and that has to do with weightings. And I talked about that in our passive versus active strategies. You got to be careful about these investments that you choose. But the basic gist of Jason Zweig's article, if you read it, The Intelligent Investor, this is from September 23rd, so about a week ago. He basically said there might be some good opportunities, and he lists some different investments in here, so you can take a look at that. So let's see. First Trust goes on to talk about, they patted themselves on the back a little bit, and they said that in June they talked that they were bullish no more, and they expect the S&P 500 to hit a new all-time high above the old. They don't expect the S&P 500 to hit a new all-time high of 47.97 anytime soon. Instead, until one of our two scenarios plays out, a recession or the realization the Fed has pulled off a soft landing, unlikely. U.S. equities are likely to be in a trading range, so equities or stocks are trading range within a potential bear market, right? Just decreases in the market, bear market rallies that come and go. So the First Trust really, there's not a lot that a lot of people are really making any big calls on right now. BlackRock continues. Let me find BlackRock. BlackRock continues to be, they say dour. Our view, not dour enough. Sour Fed growth, not dour enough. So they're saying many central banks like the Fed are still solely focused on pressure to quickly get core inflation back to 2% without fully acknowledging how much economic pain it will take in a world shaped by production constraints. Because again, all this massive monetary flow, right? So cash put in with businesses and individuals because of the pandemic and around the world again. It wasn't just the US. And then you have production constraints. So production slowed down. So now you have a lot of cash, limited production. People are willing to pay for more things that they want, and it's harder to get. So that causes inflation. And of course, you have still folks trying to get back to work, employers trying to get people back to work. That causes higher wages. That also helps with inflation. So they're saying maybe the Fed's not taking all that into account, and they're just really focused on we have to raise rates to stave off inflation. So case in point, last week's rate hike blitz, they say, this is BlackRock. This all implies a clear sequence. Over tighten policy first. So they're saying raise rates first, significant economic damage second, and then signs of inflation easing only months later. So they're saying Fed's going to choke out the economy. It's going to kind of clear itself out, and then inflation will eventually ease. So they say we're tactically underweight developed markets, stocks, and prefer credit, which are bonds, and we're going to talk about that. Prudential, the fellow from Prudential, his name's escaping me right now. I generally put DeLucia. So he has a little bit of a differing point of view. So he talked, now again, this report goes back to right after our last week's webinar. So his usually come out on Wednesdays. The August CPI report alters the economic and financial market narrative. Investors now expect inflation to remain at unacceptably high levels for longer than previously assumed. The futures market also reflects an upward revision in expectations for the path of policy rates over the next 3 months. So what does that mean? So that the futures, right, where people think that the markets are going to be, are building in these increases from the Fed, again, potentially choking out the economy, raising interest rates. And again, folks, it's not going to be that the Fed, so I think the Fed's stated rate right now has increased to 4.35. And we talked about this in our class. The average 10-year treasury historically hovers around 5.5, but it's unlikely that it's just going to hit 4.35 or 5.5 and stay there. It'll likely float through that, and we might see 7-8% in a 10-year US Treasury, and we're going to talk about what that is. And then hopefully it'll float back down at some point. So expect things, mortgage rates and whatnot, to cost much, much more before it comes back down. Again, we're going to have a tough slog of this the next year and a half, 3 years to 5 years. It might take some time for this all to balance out. He talked about the Fed is assured to raise rates this week. That was last week, so that's already done. He writes, to summarize, financial markets have developed a high conviction view that inflation will remain elevated for a longer period and that the Fed's rate tightening cycle will be more prolonged. However, there are plausible reasons to suspect that the August CPI report could be an aberration and that inflation remains in a more decisive downward trend than what was assumed prior to the August CPI. Reliance on 1 month of data has always been a risky proposition, especially when there are multiple indicators pointing to a slowdown in inflation. And he goes on to cite all the reasons why he thinks that we actually might be in a downward trend to inflation. So we've got BlackRock saying it's going to continue. It's going to take some time to drop. We have Empower, which used to be Prudential, saying it's likely we're seeing a trend down. So I always find that interesting. I want to share it with you that we have very, very intelligent people and groups saying two different things. And what is the answer? What do you do with this information? Well, it's always, in my opinion, those 3 pillars of investing: asset allocation, account segmentation, and principal protection. They're the things that are helping our clients get through it right now. I'm very, very proud of where we are right now, and you know, really our plan to kind of come out of it. So you know, that work and that process is paying off very, very well. Okay, let's jump into our financial planning topic. I don't see any questions. Let's just check here. Okay, so today in our financial planning topic, we're going to talk about bonds. So raise your hand if you can see my whiteboard. Thank you. And as always, I'm gonna put this on flat on my desk, and I'm gonna write on it. So you're gonna see me looking down. Oh, I didn't tell you in my intro, we have a new financial advisor joining the firm in October. So I'm very excited. She's also a CFP. She's also involved in the Ed Slott Group. So she's very new to the Ed Slott Elite Advisor Group. That's how I met her. And we started chatting, and we found out, you know, discovered that we had some things in common that we could do together. So she is joining our firm in October. So excited about that. And we'll have her on a webinar to introduce her to everybody. So if you're an existing client, you'll continue to work with us. Don't worry about that. But she will do some things on her own, and we'll help with that. So let's talk about bonds today. So the first question, of course, what are bonds? So bonds are debt, right? So it's debt that's issued by either governments, very simply, governments, or companies we're talking about. So any organization that can issue public, we're talking about public debt. So they offer bonds, they issue them to individual investors, and they pay interest on those bonds with the promise that you're going to get your money back, right? So who issues bonds? So I talked about this, right? We have governments and companies. So what we're going to talk a lot about today is the federal government. So the federal government offers different types of bonds, but we're going to talk about treasury bonds today. And any company, again, if I had a publicly traded company, I could go through the process of issuing bonds. You know, these are all registered through the SEC and the regulatory agencies. And then the company, you know, could issue bonds. And there's all different kinds of company issued bonds. Then and it's not unlike anything else. The company issues the bond, and then the interest rates that you receive. So, for example, most bonds are issued in $1,000 increments, and you might say, okay, I'm going to loan. This is what you're doing. For example, I'm going to loan the federal government $1,000, and I'm going to they're going to keep my money for a period of 1 year. And today, if you did that, let's see, I got the rates here. I don't have the 1 year. Okay, so we're gonna change that to 2 year. The 2 year treasury is at 4.2%. So I'm going to loan the federal government $1,000 for 2 years now. And what did I say? It's 4.2%. And over that time, I'm going to get interest payments of 4.2% a year. At the end of that 2 year period, I get my $1,000 back, right? So you get the interest along the way. Then you get your $1,000 back at the end of those 2 years. So that's how that works with a federally issued bond, or any bond for that case. Now, municipal bonds, that's a type of government bond. They're issued by local municipalities. They can really be for many things. So when I was on the Council Rock School Board, we issued bonds to build schools. We did a lot of that. I think we were close to $100 million in bonds for the schools that we did renovations and buildings for, and we would pay interest on those bonds. Now, many times, as you know, municipal bonds that are issued by your local municipalities can be tax-free. So you don't pay federal tax, state tax, and local tax if you buy them within that jurisdiction. So it would, in this case, if we're here in Pennsylvania, Council Rock, if you're a Pennsylvania resident, you wouldn't pay state tax, you wouldn't pay federal tax, and you wouldn't pay potentially local tax. So that can be very beneficial, and those rates tend to be lower because you get that tax, you don't pay tax on that interest. But as you know from our teachings, that tax, or excuse me, that interest that you receive on those tax-free, air quotes, municipal bonds do factor in the taxation of Social Security. So they're really not completely tax-free. So interest rates are determined based on what? They're determined just like an individual based on credit quality. So the US government is considered the safest credit quality, right? At least for now. So that's why you typically get lower interest rates for, and you're going to see that in a moment, for US government bonds. Actually, let's share that. So you'll see here where here's the 2 year treasury. And here's a 10-year treasury. Now look at this. The 2 year treasury, you get 4.2%. That's for holding your money with the US government treasury for 2 years. You get 4.2% along the way annually. If you put your money with the federal government for 10 years, you get 3.68%. So that's a challenge we're in right now. We're going to talk about that. Would you want to put your money into the US Treasury for 10 years at 3.6% if you could just hold it there for 2 years and get more interest? Probably not for most people. There may be reasons to do that, but probably not for most people. But let's look at what this means, and I'll explain all these. So this is Bloomberg, Barclays, investment grade corporate bond index, right? Or where their bonds closed. So closing the last week, 9/23, so that's Friday, they averaged, so this is average, right? Average interest rates was 5.1. So better credit quality here of the US government than of the, this group here, this collective investment grade. That means higher quality companies, bonds. So you get more interest for taking the risk associated with investing in these types of bonds compared to the US Treasury. Really no risk. Your $1,000 that you buy that you spend on one individual bond with the US government is certainly going to come back to you if you wait two years. you're not guaranteed to have that. That has the full faith and credit of the U.S. government. You don't have the full faith and credit of the U.S. government with individual companies. So you get more interest for taking that risk. Now, high yield, this is the same Barclays, Bloomberg Barclays, high yield corporate, right? So these are private or publicly traded companies. High yield is lower credit quality bonds. So they might just have, their books aren't as strong, their revenues aren't as strong. So look at, you get 9.25% annual for that, but you're taking more risk with your money. You're not guaranteed to get that money back at any point, right? So you're taking more risk. You're likely to get the money back, but no guarantees. And this is what I was talking about muni bonds. You see municipals, 3.87%. So you get a little less than the 2-year here. Actually, this should be less too. Interest rates are just crazy all over the place because you don't pay, as long as these are structured properly, you don't pay tax on that interest. Of course, they could contribute it to your Social Security being taxed, but you shouldn't pay tax on that interest for federal and state, and depending if you're buying it in the state where it's issued. I know it gets a little complicated. So, and then high yield munis, there can be lower credit quality municipal governments and you get a higher rate of return. But again, you're taking more risk that your full amount that you invest in there won't be returned to you. So the safest is commonly known as the treasury. So any treasury note, you can get those funds back. I see a question, or you will get those funds back. Walter mentions U.S. government I bonds. I don't know if we have time for that today, Walter, but we can talk about that at another time. Good point. You can see that we have a 6-month treasury here, and I'd have to look up what the 1 year is done with. Even as the 6-month is 3.86%. Let's look where it was a year at the end of the year 2021. It was at 1.8%. 1 year ago, this time last year, same day, it was 0.04. So you can see just how much interest rates have increased since last year. The 2 year is 0.26. Now it's 4.20. The 10-year is 1.43. Now it's 3.68. So massive increase in a short period of time. And it's partially driven by the Fed, of course, right? The Fed continues to increase interest rates, but it also is just driven by the markets. The Fed can't put a cap on where the markets are going to go as far as interest rates. And so that's why sometimes you see, the run up of interest rates, and then the Fed might stop increasing the Fed funds rate. This is what when you hear about the Fed increasing, this is what they're increasing. But the markets might just take over and go right through that, which is what we're seeing now. So the last mortgage rate I saw last week at my credit union when I stopped in there was 6.125%, which is much, much more than it was, a year ago, of course, or even really 6 months ago. So this is where consumers really get hit. Of course, this is where investors really get hit, right? Because this is the other part of it. If we know that interest rates are going to continue to go up, are many people going to put money into a 10-year treasury that's paying 3.68% when they can own a 2-year treasury that is paying 4.2%? When we know that if the Fed continues to raise interest rates, if they raise another, 1, 2, 3% over the next 12 months, who the heck knows? These rates will continue to push up. Now, let me explain what I'm talking about. So my next point is, are bonds safe? So I think we understand interest rates right now. What are bonds? We talked about who issues bonds. Now, are bonds safe? We talk about this a lot. People consider bonds as a safe alternative. You've heard me talk if you're a client, you've heard me talk about this for years. If you're attending the webinar, you certainly have heard me talk about it since we started these in March 2020. But why are bonds, I think, one of the riskiest asset classes and investments going forward? Because this is what happens. I'm going to come back to this yield curve. Oh, and here are some of the losses I talked about, and why it's so perfect segue or discussion item in this. Here's your average. Here's where your average bond investor lives, right? And your safe investments have produced a negative 13.75% return so far this year. Why is that? You see, even the shorter term 1 to 3 year bonds down almost 5%, 4.5%. Well, this is why. Remember, I said you buy these bonds at $1,000 increments. And let's go back and use the actual numbers here. And let's say a year ago, you bought a 2-year treasury. So in what's today? On 9/27/2021, you bought a 2-year treasury bond that matures then on 9/27/2023. And that bond that you purchased, let's go back to that rate, was 0.26%. So for that period of time, holding that period of time, you're receiving 0.26% annually, right? So you get an annual return. You get paid periodically, but you get an annual return of 0.26%. Well, now here we are 1 year later. So now let's sneak this in here, right? We're at 9/27/2022. And let's say you have $100,000 in these bonds, and you say, well, wait a minute, I am getting 0.26% on these bonds. I have another year to hold this. I can now get 4.2. Is that what it was? 4.2%. Why don't I take this money and sell it and buy for a bond now in 2022 at 4.2%? Well, who's going to pay you $100,000 on bonds at 0.26% when they can go out and get brand new bonds on their own? I had one extra 2 here at 4.2% in 2022. Do you follow me? So what's going to happen is if you sell this, and this is why you see this $100,000 may be worth, there's a calculation you could do to see exactly what it'd be worth, but it would be significant. This $100,000 might be worth $80,000 on your statements. I'm not sure if that would be dramatic, that dramatic, but let's just use an example. Because if you sold that in the open market today, people are going to have to pay a discount on that value to get anywhere near the same type of earnings, right? Because they have to make up that 4% difference, and they have to make it up in a year. So actually the discount might be steeper than that. I should have done that calculation because I bet it's shocking. So that's why bonds it can be risky as interest rates go up, because you're holding these bonds, and as interest rates go up, the bonds that you have are becoming worth less and less and less, because 1 year is no big deal. You can wait another year and you can just receive your 0.26% and then just rebuy new bonds if that's what you want to do, and you'll be getting them at the higher interest rate. But what if you have one of the 10-year treasuries that was at 1% when you bought it a year ago, and you had to wait 9 more years to fully get your money back? And that's where the trouble lies, because you may be able to wait 9 years. It may make sense for you to wait 9 years, or you might just say, I'm getting hardly nothing for this. Inflation is at 8.3%. I'm getting 1%. I need to do something. So that's what the issue with the pricing of bonds. Now, you just might say, well, that's okay. That's a portion that I can just hold on to. Why would I sell that and take a loss? I can't. Maybe they're in your retirement accounts and you can't take a loss for a tax effective, or you can sell it at a loss, but it's not going to help you on your taxes. And that might be a fine strategy, just holding those bonds to maturity. But most people don't buy bonds that way, do they? No, they buy them in mutual funds or exchange traded funds, or ETFs. And these are priced every single day. And in the case of ETFs, they're priced all day long on the open market. So we're getting accurate pricing on these bonds within the mutual funds and ETFs. And frankly, they're traded all the time, right? So it's not like you can hold something to maturity. Mutual funds and ETFs have like a perpetual maturity. So you don't have control over those individual bonds. And that's why you're seeing these mutual funds and ETFs that hold bonds that are down. And frankly, I think that downturn and that climb away to where we start seeing positive returns is going to be much longer than the stock market. So, okay, it is 10:50. We've covered, I didn't do my switch over during our financial planning topic section, but that's okay. But we've covered some market thoughts today, market activity. We've talked about some items from the Slott report, and for our investment fundamentals, we talked about what are bonds, how are they priced, what are some of the risks, what are some of the rewards. We talked, the rewards. I talked a lot about the risks. The rewards are, of course, if you own treasury bonds and you own them individually, you're always going to get your money back unless the federal government defaults, which is very unlikely. Determine the credit quality of what you're using. You can get really caught up in just looking at funds or individual bonds and what their past 3-5 year numbers have been. So just pay attention to those credit qualities. There's how long you're going to be holding those bonds for. Even what I don't want to get into it too much, but what we call duration, how much the real life of those bonds are. So I hope that's helpful. This is meant to be on a very, very high level, just to give you some exposure. We didn't get to talk about the inverted yield curve, which you can see here. This is normal, pay less interest in early years, and as you lock yourself in for later, longer periods of time in your investments, you typically get more interest. Here's what we're seeing right now. As you saw, we get higher interest in the shorter term and less interest in the longer term, and that is what we call an inverted yield curve, and that is not a good sign for the economy, and certainly for the idea of a recession. So that's it for today, folks. I do see a question. Doug asks, are you better buying individual bonds rather than mutual funds to be patient? It all depends, Doug. So it depends on your situation. If you can find bonds that fit your situation, and then you've got it. This is where account segmentation comes in, because you don't want to buy a 10-year bond for money that you're going to need in the next 3 years, let's just say, because you may not have the ability to hold that bond for 10 years. Now, we're in an unusual situation right now because of the way interest rates are, where you're getting less interest for a 10-year bond than you are for a 2-year bond. So most people aren't chasing that higher interest, but that's typically what people do. And the yield curve will correct at some point, and people will find themselves saying, well, I probably won't need this money for 10 years. And I want to get a higher interest rate. But you really have to plug these into your account segmentation, and that is having a defined pot of money or investment strategy for each portion of your life. So if you have questions, we can talk live, Doug, but good question. We'll see everybody next week. I hope this was helpful. Take care. Enjoy the rest of your week. Take care.